off with the approval of foundation minutes. Oh, I'm sorry. We gotta do the roll call first. It's been a while since I had a gavel.
Go through it here. Laura Blaney. Andy Bozak.
Present.
Sylvia Graham.
Present.
Mike Bittner.
Here.
Red Stone. Here. Jeremy Rivas.
Here.
Greg Sims.
Present.
Andy Vasquez. Barb Regnitz.
Here.
Jim Biggs. We have a quorum.
Okay, we got quorum. So next we're looking for approval of foundation minutes from March 21st, 2023.
Motion.
Second.
We have a motion and a second. Any discussion? Hearing none. All those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Next on to new business. Resolution transferring foundation earnings transfer for $5,501,803.53. So it
We
looks
didn't have this at our first meeting of the year. This is the resolution that the board needs to pass in order to move the earnings from the management account to the holding account.
all right.
And this is the amount based upon the smoothing calculations from 2022.
Motion to approve.
Second.
And a motion and a second. Any discussion? Hearing none. Is this a roll call or voice vote? Scott, is this a voice vote or a roll call? Does it matter?
Roll call.
Roll call. Roll call, please.
Andy Bozak.
Yes.
Sylvia Graham.
Yes.
Mike Brickner.
Yes.
Red Stone.
Yes.
Jeremy Rivas.
Yes.
Greg Sims.
Yes.
Barb Regnitz.
Yes.
7-0.
All right, thank you. Motion passes. Next, we've got our capital cities presentation.
Okay,
Just take it up.
sure. Good evening, everyone. My name's Amanda Black with Capital Cities, and I'm joined by my colleague, who many of you have met, but not everyone, John Williams. John is an associate consultant of manager research at the firm. So wanted to have him come along this time to meet everyone. So we are going to cover the normal quarterly report like we would at this time, but because of the timing of your meeting, it is what we're calling a flash report. It is slightly abbreviated just because the quarter ended not too long ago. We'll follow up by email with our full comprehensive report in a couple weeks. With that said, this does still have all accurate and audited data. It just doesn't have as much data as we would normally include. We also have the alternatives education presentation that I'll touch on for a second at the back, and then John might jump in more on that depending on what your preferences are there. So we'll get to that in just a second. So on the flash report, if you look at page 2, hard to see the page number there at the bottom. It's kind of stuck inside the chart. It's what's up on the screen as well. Here is where we just give you a quick backdrop of what was happening in the investment markets during the quarter. So here we're talking about the second quarter ending June 30th. Was great to see some strong performance in the equity markets. That certainly benefited the Porter portfolio. The reason for that strong equity performance had to do with the strong economic backdrop. Employment numbers remained favorable. In other words, unemployment was low. Even though inflation continued to be above the Fed target, it has come down from where it was a year ago. So that was generally well perceived by the market. And in that environment, stocks did pretty well. Growth stocks outperformed value. Information technology was the best sector by far. So we saw that in your portfolio as well. The only negative sectors in the stock market were energies and utilities. So the stock market was strong both in the U.S. and non-U.S. markets. Within fixed income, we saw a little bit more of a mixed result. The Fed raised rates again in May, but paused in June. In this uncertain rate environment, fixed income prices were pressured a bit, so we saw some not as favorable results there. At the bottom of the page, this chart is just broad investment markets, specifically fixed income, and you can see that returns, unfortunately, within bonds remain negative over the one-year period across many styles of fixed income, and those are the gray bars, and even for the quarter, which are the blue bars. So the aggregate index is the fourth kind of set of columns over. That's the broad proxy for U.S. fixed income, and unfortunately, we're still seeing negative returns there. With that said, you did have some positive performance out of some of your fixed income managers. So on the next, I'm going to skip the next couple of pages. These are here for your reference if you'd like to get into more detail on the equity and fixed income markets. But I want to take you to page 5. It says asset allocation and performance at the top. This is where we have the Porter County actual results as of June 30th. So that blue bar at the top shows your total portfolio market value at $176,659,471. The return for the quarter was a positive 3.59%. That just barely outperformed your benchmark, but still strong results there, slightly above the benchmark, and that is net of fees. Over the last year, your performance, that's the last 12 months, is 9.2%, and then you can see longer dated numbers there out to the right. I want to just show you that number all the way to the far right since inception. So going back to April 1st of 2016, you have exhibited an average annual return of 5.7% in this portfolio, which beats not only your benchmark, which is a passive representation of your asset allocation, but it also beats your performance bogey that you've set for yourselves, which is 5% a year. Your managers performed according to expectations. Not surprisingly, you have passive equity that performed right in line with the benchmark. Within your active equity managers, those who had more growth orientations, higher allocations to information technology, consumer discretionary, they did better than your value managers who had more defensive allocations within utilities and materials and energy and things like that. With that said, you have that mix in your portfolio on purpose. We're not trying to bet on growth versus value. We're trying to show aspects of both. So this was a period where the growth managers outperformed. Within fixed income, I told you about the negative environment overall. With that said, you still had a handful of managers who eked out a slight positive return, which was nice. So all in all, a strong quarter. I did mention this is a very abbreviated report. It ends after page 6. We'll follow up in a couple of weeks with all of the detail where we show all of the analytics and the peer comparisons and things like that. Any questions on the performance report before I switch to the next document? Okay, so behind tab 2 for the hard copy, you'll see the alternatives review. I want to just take you to that first page where there's a lot of text here for a second. Just remind everyone kind of how we've gotten to this point. So over the last several quarters, Capital Cities has been providing education on alternative asset classes to the board. This is something that we have been recommending to many of our clients, including Porter County, to consider, but it's not a cut and dried decision of whether or not you would implement alternatives. From a risk-reward standpoint, we think alternatives have a lot of value, particularly for a foundation of your size, because of the diversification benefits and potential alpha that they add. With that said, they have higher complexity, higher fees, and require more oversight. So this is something that we've been talking about for several quarters with you all. We had tabled the discussion because there were some new board members, and we wanted to give everyone a chance to kind of, learn about this. So this is not something that we are necessarily pushing on you by any means. You as a group have discretion over what types of asset classes you ultimately invest in, and we advise you on that. So with that said, we wanted to bring this back to the table. We have a document here that goes through all levels of detail on these assets, not just the asset class as a whole, but also the individual managers we would recommend. So we're really looking for your feedback on whether you'd like to hear more about this from us. John is here too to help discuss some of the managers, as he does significant research on these managers within our team. So I want to kind of maybe stop there and look to you to see how you would like for us to proceed with this.
My concern was the cost of it, how much more of an increase. What would be the,
Fees?
fees, but also, is there that much more of a benefit we could reap by going with this? Because it's gonna cost more.
Sure.
And you said it's more intensive base, so it's and is the fee based on how much time they put into it?
And, yeah, why don't you jump in?
Yeah, I can-
And maybe repeat the question too, so.
Absolutely. So just to answer your last question first, are the fees tied into how much we give them or how their performance or anything along those lines? The three managers that we're bringing to the table within this alternatives bucket, each of the managers have a flat fee. We've had negotiations with these managers, and because of capital cities, we've been able to get access to share classes where you would generally need a minimum of 150 million in order to gain access to these funds. That comes at just a 1.5% flat management fee. So really our thought in bringing this to the table was institutional caliber funds, in diversifying asset classes that the foundation hasn't had access to before. And I want to.
And just to clarify too, our capital cities fee doesn't change. We would monitor these funds and perform due diligence on them on your behalf, but we are not proposing a higher fee from our standpoint. We also have no affiliation or any connection to these managers other than kind of being your advocate when we go out and talk to them. But
Is
then,
there in addition to the management fee, do they also have performance?
They do not in these share classes, no.
and so to put John's words in differently, you typically would see that. We were able to push these managers to allow you to access their premier share class that strips that out and is more straightforward. The reason they are willing to do that with us is because we have 33 billion in other client assets to which we consult, and they know that. So we can sort of use that as leverage to help all of our clients get a better deal.
Do you have any sense of the actual transactional fees? I know they don't have to report that. Do you have any percentage?
In terms of the underlying transaction
Yeah,
fees of the
yeah,
actual
yeah.
stocks and bonds.
Right.
That would all roll up into the total all-in fee for this specific fund. That I'm talking about here is the North Rock Fund of the 1.5% management fee. So you wouldn't see any of those transaction fees coming out of your netted performance.
But Cliffwater would have transaction fees. So maybe it would be helpful to look at page 7, but I want to make sure we cover Sylvia's first question.
Yes,
Let's touch on that real quick.
Absolutely.
The-
I just was trying to finish up
Yeah.
on the fees.
yes.
Yeah, and so her first question was,
The
you know,
different-
your fees are really reasonable right now. I think your total weighted average expense ratio is
46 basis points.
so just shy of 0.5%.
And if you included the new alternatives at a 20% weight like we have proposed, that would bring your overall total portfolio fees to 64 basis points or 0.64%. So an
So-
increase of around 18 basis points.
So to us, we wouldn't be putting this in front of you if we didn't think it was worth the higher fees. And those fees are still quite low overall, well below 1%. 1% used to be kind of the bogey. That's not a fair number anymore because of all the fee compression across the industry, but you're still so far below that 1%. But back to your question. So Sylvia, does that answer your
Yes.
question? But about I think it's important to know that we're talking about 3 unique funds. So they all look a little different in how they act, what they do, what they charge, how they charge it, and so on. One of them is just a mutual fund. So that's very straightforward. That's the Lazard Global Listed Infrastructure Fund. That's daily traded, daily liquidity, and you just pay the expense ratio, and it's netted out of performance. North Rock, you just covered.
Is a 1.5% flat management fee for the specific share class that we would be getting into. And then if you look at Cliffwater, which is the far right-hand side, that 1.63%, that's a flat management fee cost, and that's actually came down, and I can explain how that's came down over the last 1-year period, but you see how it says plus borrowing costs. They use a minor credit facility that they need to use at times to bridge capital in and out of the fund when different investors come in to invest. On an average quarter, that may be between 0.03% and 0.05%, so bringing the total below that 1.7%.
On your page 5, where you're showing investment returns, total portfolio and with the alts, what kind of mix are you?
That's a great question. If you actually go to page 3, this just gives a brief snapshot on the left-hand side of the current structure of the Porter County Foundation, and those returns that you're seeing on page 5 are that recommended structure that you see on the right-hand side. So what we were proposing is a 20% allocation to the alternatives, and then if you go forward to page 4, that shows how that's broken down into each of those 3 managers that we mentioned just a few moments ago.
On those funds with not daily liquidity, are you required to mark to market every single day regardless?
Both of those funds are required to market every day regardless. Yep.
Do you have any projections as to how they did in 2008 and 2009, or didn't they exist back then?
Neither of these funds have a track record back to 2008 other than the Lazard Global Infrastructure Fund, was in 2009. So none of these funds have a track record back to 2008.
Yeah.
One thing that I would maybe mention just briefly on page 5, and just to explain what you're looking at here, the blue is the Porter County total portfolio as the asset allocation is today, and the green is as if we added in these new alternatives. In strong bull markets, when equity and fixed income have very strong returns, we would expect your portfolio to outperform the portfolio if we included alternatives. An example of that is calendar year 2020. You can see that there. If you remember, they injected all of the stimulus into the economy. The S&P 500 was up 18%. The bond market was up 7.5%. In mixed or bear markets, we would expect the portfolio with the alternatives included to outperform your current portfolio allocation.
So this is just, more downside protection?
Downside
That's
protection
what-
and risk mitigation.
So our concern is, and one of the key reasons to bring this to you is because of how much fixed income you have. And feeling the need to diversify away from that. So statutorily, you can only have so much equity. So you have more fixed income than the typical foundation. So we were trying to think of ways to diversify that fixed income risk. Now, right now, your fixed income looks pretty great, save this last quarter, with rates, up in the 4 and 5% range on cash. But it's not always going to be like that. So we're trying to mitigate some of the interest rate exposure in your portfolio by introducing slightly different asset classes.
Do you
But-
have downside capture numbers for any of these funds?
Well, we have the risk return chart.
Yeah.
It's how much of the downside do they actually realize when it's down? And upside capture is how much of the upside do they realize?
So we can, did you run?
I did. If
Oh,
you-
yeah, it's there. Okay.
So if you went to page 14, within this component of the deck, it just shows some basic statistics. The bar chart can be a little confusing if you look at it, but that's just the output of our software. But you can see those statistics down there at the bottom of the page. That first one being, what you just mentioned, the downside market outperformance. So the Porter County total portfolio, when there's been a down market, has slightly underperformed the passive target. And then when we include the alternatives in the portfolio, we are seeing some alpha in that downside scenario. Similarly, though, if you look at the upmarket performance, which is down there at the very bottom, you can see the Porter County total portfolio is showing stronger alpha, the current allocation of 1.02% relative to if we included alternatives in the portfolio.
What's the subscriptions mean? Why does it say monthly or daily for the other two?
That's a great question. So a subscription is just when you enter into a fund. So just want to describe, if you go back to where we had that grid page, might be easier to land there. Yep.
There?
Yeah,
Okay, that's fine.
Yeah, just land on the grid page. So the first one, the North Rock Fund, this has monthly subscriptions, so we could enter in at the beginning of every month.
Thank you.
Yeah, so these managers like for the assets that they're managing to be a little stickier so that they can put them to work more efficiently and effectively than a mutual fund that's just got money coming in and out and in and out. So they are, because of what they do, they're able to manage that by putting parameters around when you can put your money in, when you can take it out.
So should we wait till the fixed income's worse off to do something like this? Because
You
we're
gonna tell
actually-
me when that
I don't know.
happens?
You see a trend, right? That's what you're there for, to tell us it's trending. It's
We're not
happening.
market timers. We're thinking about this foundation for the very long term. So I forgive my flippant comment.
I didn't think
But we're not trying to call the market. If we were doing that, we'd have a job sitting at a trading desk. We're here to protect you as fiduciaries and make strong decisions for this foundation for a very long time. Now, this may not be right for you. This is would be a big change. If you think about the evolution of what this group has done together, you started out with just a little bit in equity, then you pushed that a little bit as statutory limits allowed. This is the next thing to think about, but it doesn't have to happen tomorrow. But it's our job to educate you on what's out there, what your peers are doing, pros and cons, things like that.
And I think one of the main reasons that we brought, these specific funds and managers to you is these are very institutional caliber. They have large minimums that we've been able to get waived through Capital Cities and giving you access to asset classes at just a lower fee schedule than you would see from other managers or funds that are doing the exact same thing.
But I think what you are hearing from us, I hope, and thanks to your questions, all of you, is that we're not trying to swing for the fences with these. This is more of a risk mitigation and diversification tool that should help you more in the down markets than it does in the up markets. Right now, we're in a period where we're finally seeing some nice positive returns, so it might be harder to think about this. But again, we're planning for the long term. And we could run more reports. We've talked to these managers without giving specifics about exactly who you are, just for privacy reasons, but they would be willing to get on the phone with you or on a Zoom. We could do any level of digging into these. That's at your, preference.
Any interest or? Question?
Can you go to the green blue slide real quick?
Which,
That. How many more years do you see up and down going forward?
I would anticipate a bell curve.
Just your normal one?
If I had to put a guess on it, I would say, well, let me point to some data. That's a safer thing for me to do. The expectations in the 10-year looking ahead period from economists across the world, pick which ones you want, whether it's JP Morgan, Wells, UBS, et cetera, are that stocks will perform about 8% and bonds will perform about 4% in a given year. With that said, they also say that next year could be 0 and the year after that could be 16. And that's how you get your 8. Or it could be -8 and, positive.
So in dollars and cents, could you say if we decided to go from 18 to 23 with the alternative plan instead of the plan that we have now, what difference would have been?
Yeah, so let's look at page 13. And I want to really caution you here because there's a thing in data analytics that you want to avoid, and that's called, data mining. You can find the data you want to tell the story you want. And everything is time period sensitive. So what you're looking at on this page is if we had done this going back to the inception, which was April 1st, 16, how would you have done? So that's a very specific point in time. I can't guarantee that that would replicate into the future. With that said, this is showing you that you would have earned 6.1% on an average annual basis instead of 5.4. Now, there's a big problem there. You weren't allowed to have this much equity in the portfolio for the first few years of that. So we've already got noise. We didn't back all that out.
Yeah, a million variables at all times.
Yeah.
I understand.
So we think it could be slightly better for you. We certainly think you could have downside protection. We think it could be really great if equity and fixed income markets go haywire. And in any case, we think it should smooth the road over time.
Can I ask you a question? Since we're smoothing anyway, why do we really need to put alts in? It just, to me, we're smoothing and and we have conservative, great managers, right? I just don't understand why we want to introduce complexity and.
That's the dilemma in a nutshell. If you go back to that page that John pointed to with the data, where's that, page 14? One thing that I look at is information ratio, and that is, or excuse me, Sharpe. I want to look at the Sharpe ratio. What that means is return per unit of risk. And again, this is all time period specific, but what this tells me is that if you had alts in your portfolio, you would have a higher Sharpe ratio. That means you would get more return per like units of risk. But that doesn't count headline risk, complexity, fees, potentially not having a consensus of the group.
Operational
You can't
consensus.
measure that.
Any other
returns
questions?
over life of all three funds?
Yeah. Do we have that
Yes.
in the?
If you keep going farther back, I'm not sure if I have all the way back since inception.
Yeah,
but I
because we
have-
kept them apples to apples.
Yeah, I kept it more of an apples-to-apples comparison, but I have it going back 1 quarter, 1 year, 3 years, and 5 years for each of those three managers, and would be happy to provide any additional since inception performance as well.
This may be a dumb question, but if we would do this, is it easy to get out of it?
Not as easy as your current managers. No, that's actually, that's something you should be thinking about. So let's look at page 9, or excuse me, 8.
Yep.
So that's another, so the question was, if we did this, would it be easy to get out of it? It would be easy, yes, but less easy than if you were just all in mutual funds. And there are times where it could not be as easy as you would like. That's lined out on page 8. Let me give you an example. Cliffwater, one of the three funds, requires 90 days written notice to take a withdrawal. If something went terribly wrong with the market or the environment, or even this fund, and every one of their investors put in their 90-day notice, Cliffwater could say, we're going to gate this. We're going to put parameters around this. We're not going to give it to you all at once. That is possible. So there, you do give up some of that liquidity. You give up some of that certain liquidity. Now, we think these terms are much better than your typical alternative fund. There are foundations out there with large allocations to private equity with 10 and 13-year lockups, or private real estate with 10-year lockups, hedge funds with year lockups. These are not at all like that. These are kind of a baby step into that alternative universe, but it's still a movement from where you are today.
Anyone else have any questions? Okay. I think we're still just gonna
Yeah.
see what happens and go from there.
And our goal is education, and, we want to be here for you as your advisor. So please use us as that, and we'll keep bringing this in front of you, but we won't push it on you either.
Well, thank you guys. Appreciate
Absolutely.
everything.
Okay, that's it. That's what we had on
You
the,
guys have
yeah.
a safe trip home. Thanks for coming up.
Thank you all, appreciate it.
Safe traffic.
Thank you.
Next up, we got attorney's report.
I have nothing.
Okay. And lastly, we've got the approval of claims, Capital Cities, second quarter, April 1 to January 30th, $16,250.
Motion to approve.
Got a motion?
Second.
Got a motion, a couple seconds. Any discussion? Hearing none, roll call, please.
Andy Bozak.
Yes.
Sylvia Graham.
Yes.
Mike Brickner. Yes. Red Stone.
Yes.
Jeremy Rivas.
Yes.
Greg Sims.
Yes.
Andy Vasquez.
Yes.
Barb Regnitz.
Yes.
Jim Biggs.
Yes.
9-0.
Anything else that you guys had to?
What's the next meeting? Because I have
Good
no
idea. We should-
idea.
Do you guys
I
want to
don't
set that
know
now?
what they are. I'm not gonna-
2 months from now, or
Whatever you want to do.
you want to just circle back when Laura's here and
That's a
figure
good
out what
idea.
to
Yeah, probably.
her headed up? Okay. We'll have Laura email us all and give us some dates and go from there. All right, if nothing else, looking for a motion to adjourn.
So moved.
Second? All those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Thank you, guys. Have a good day.
Well, you hit that gavel hard.
Yeah,
You got
yeah,
some
yeah.
anger
She
issues?
gets 20 years, so I'm using it.
But if you want to sign it.